Hi, I'm Chris Summers with Unhedged.
And I'm Austin Hankwitz. Welcome back to another segment of our interesting ideas, but also maybe just getting the conversation rolling about a company that Chris has found that is certainly interesting, that we just want to get some feedback on, have a conversation about. And that company is Radius Global Infrastructure. Chris, I'll let you take it away here.
Sure. So this is going to be a little bit different than what we've done in the past. This is a fairly complex situation that is probably not for everybody. But the nice thing about going through this is it'll be very educational, and we'll talk about some financial engineering, which is really not that different than how banks work, arbitraging yield spread between the asset side of the balance sheet and the liability side of the balance sheet. So let's get started into Radius and explain exactly what they do and how they work.
Let's do it.
So Radius operates in the cell phone tower space, and what they do is they actually lease the underlying land the towers sit on top of, and then those towers have mobile operators that then lease space on the towers, and those two different constituents pay a lease amount to Radius Global, who used to be called AP Wireless down here. This is a dated presentation. But you can see here their customers are companies like AT&T, Sprint, Verizon, and then also tower operators like American Tower, which is publicly traded, ticker AMT, and Crown Castle. So basically what they do is they'll go to a landowner or somebody that has an existing lease, and that person might be making, say, $15,000 a year from the tower companies and the cell phone carriers. And Radius will say, hey, I'll just give you $250,000 up front if you let me take over the lease. And the only way this works from a financial engineering perspective is if Radius Global can achieve such a large scale that they can bring down their cost of capital. And cost of capital means how much money or interest they have to spend on the debt that they borrow against, and also their cost of equity, which is a bit more of a complicated conversation, but we'll walk through that in the model in a little bit. Any questions so far, Austin?
I don't think so. So it really just sounds like this company's coming in and snatching up these leases, and then it sounds like they're trying to figure out a way to sort of arb the difference between sort of what they're paying and what's going on with the previous owner and what they think they can get in the future. Similar to how you said a bank does it, right? They take our money, then they pay us a little bit of yield in the savings account, but the only reason they can pay the yield is because they're lending out the money for that car loan or something else in the future.
Yeah, more or less. And the extra little kicker they get on the economics is they typically get rent increases every year of 2 to 3%.
Okay.
So that helps kind of juice the returns. But if you read the most recent conference call from Radius Global, which I have on here, they start to talk a little bit about the economics. I've already made a lot of highlights, and people that pull this up on Unhedged can view these highlights for themselves. So they currently have 7,750 leased streams. That's 40% tower companies and 60% mobile network operators. And then the real math comes in down here, where they talk about how much they spent for the new sites they got, and then how much rent they're going to take in. And this gets into the yield on the assets. So in this case, they spent 125 million bucks in the second quarter for 282 new lease streams. And then in return for that, it added $9.2 million of revenue. And I should add that the revenue pretty much falls 100% to the bottom line because they have no costs other than their selling, general, and administrative expenses, which are currently relatively high as they're still somewhat subscale. But getting into the model here, I'll pull over to it in a second. We've done a lot of analysis on what the economics look like, and then there's some assumptions on what their cost of debt is. Coincidentally, they actually announced today they did a convertible bond offering. You can read that press release on Unhedged as well. And the convertible bond offering, they were able to raise money at 2.5%. It converts into equity, of course. And I've also made the highlight here. So it'll convert at $23 per share or so. The stock's currently at $17.41. But let's get into the unit economics. So as we said, what we saw on the call was they spent $125 million to add 282 leases in the quarter. So they spent $444,000 per lease during the quarter. And we know that prior to this, they had 7,748 leases total for an average of 7,400 over the first half of the year. And they currently have 1.3 billion roughly of assets. So their average cost per lease prior to these new deals they're doing was $165,000 per lease. And you can calculate what the yield is they're getting on that by dividing the cost of the lease into the revenue from the leases. So you divide the revenue per lease into the cost, and that gets you their yield. So during the second quarter, as we said, they added $9.2 million of incremental revenue. So you divide that 9.2 million into the 282 new sites, and you can see that on average, they're now getting 32,600 on these new sites, which turns into a yield here of 7.3%, which is simply the 32,000 that they're getting in revenue per site into the 444,000 they're spending per site.
Right.
Now, these numbers don't sound too high off the cuff, and it might look relatively boring, which was initially my reaction when I was looking at it. But I noticed at the same time that the company has some fairly high profile fundamental investors that have been very successful over the last 20 years. You can see Eminence Capital just bought a lot of stock in the second quarter. Third Point is a shareholder, Alyeska. These are firms with very long-term track records and very attractive returns. They do very deep work, and in most of the cases, they run very concentrated portfolios, so they don't make a lot of new bets per year. So when they do make a new bet, it's worth doing some homework on. So illustratively speaking, I guess the total market, which you can see in the investor presentation, when you go to the Radius homepage on Unhedged, you can pull up the presentation. And within this presentation, they talk about how large the market opportunity is. Austin and I just threw this model together a little bit ago before the call, but the total number of cell sites in their markets plus the growth they expect over the next 10 years is 1.8 million sites. So Austin and I decided to say, well, they've got 7,500 sites now. They're currently adding maybe 1,000 a year. That's obviously going to grow quickly. So let's say they can do 2,000 next year, then 3,000 the next year. After 7 years at that growth rate, they would have around 30,000 sites. And then we just plugged in some numbers. It kind of doesn't matter. The most sensitive things here would be the yield on the revenue from the site or the cost to acquire a site, and then the cost of the debt, both of which have been fairly range bound over the last 10 years in this space. So if they can get 30,000 sites at $20,000 per revenue per site, which would be above the 12,000 they're currently getting across the entire portfolio, but well below the 32,000 they just got in the second quarter. We said, what does that look like? Well, that would get them $600 million of total potential revenue. And then we said, okay, what would that cost them to acquire this revenue, which is the yield? So you do the inverse math on that, and you end up with their spending $285,000 per site for all 30,000 sites. Notice the yield we picked of 7% is lower than the 8% across their entire portfolio, and also lower than the 7.3% they just got. You could argue that's somewhat conservative. The next step is to say, okay, well, how much total dollars then will they have to spend to get all 30,000 sites? And you multiply the 30,000 by the 285,000 per site, and you end up with around $8.5 billion. So as we showed earlier, the total assets of the company are around 1.3 billion, and they have debt of around 883 million. Because these cash flow streams are viewed as very stable and recurring, generally the debt markets will allow a very high amount of leverage on assets like this. So currently they've financed around 70% of their asset base with debt. So for the purpose of our analysis, we said, well, what happens if they finance 66%? That would require 5.6 billion of new debt.
Mhm.
And we assumed a cost of debt of 4%, which would be interest expense of 226 million. So if they're going to get $600 million of revenue, and their major cost really is just their cost of debt here at 226 million, they would end up with profits of around $375 million. But let's not forget, they're going to have to raise equity too, because out of the 8.5 billion they're going to have to deploy, they're only going to be able to borrow somewhere between 65 and 70% of that. So to calculate the equity required, we look at, okay, the total capital is 8.5 billion minus the debt gets you to around 3 billion of equity required. Now, the current share price is around $17 per share. It's already up like 70% year to date. The forecast we've got in our model is that the stock price will go to around 60. So we took the low end of an average and said, over the next 7 years, we'll assume they can raise this $3 billion of equity capital at an average price of $35 per share. Now, that's obviously higher than where it is today, but presumably lower than where it will be in 6 years if they can maintain this growth trajectory that they are trying to be on. So the current shares outstanding at the end of the second quarter were around 75 million. Then you can calculate how many new shares will have to be issued, which is that 2.9 billion of new equity divided by the $35 per share. So they'll need to raise another 83 million new shares at 35 bucks. That gets you to new shares outstanding of around 160. So setting aside any general and administrative overhead expenses for now to keep the math more simple, and as you've been listening, you probably can see the math is nothing simple about it. They would then end up generating around $2.35 per share in the future. That's from the profits we calculated, the revenue minus the interest expense, divided into our new share count. And typically companies like this trade at a very high multiple. We can see that if we just take a look at AMT, for example, American Tower, which is another tower company. So tower company AMT trades at 55 times price to forward earnings, 53 times price to forward earnings, 30 times EBITDA. They trade like this because they're viewed as just perpetual cash streams, and they end up getting kind of pegged to the US 10-year treasury bond. So we conservatively said, what if the stock is then trading at 25 times the $2.35? You get to a long-term stock price of around $60 per share. We did a little IRR calculation. If the stock goes to $60 in 7 years, and it's currently trading at $17 and change, that ends up getting you an IRR of around 19%. Which is far more attractive, of course, than the 7% or the 8% you see on the surface. Now, the catch here is that this is what's called a levered yield. And it's not only a levered yield, it's a very levered yield. So you're really taking a bet that, well, a couple of things. One, that they're going to be able to grow like they want to extremely quickly. Two, that they're going to be able to continue to get attractive yields on the sites they purchase. That's the revenue yield, that's 7 to 8%. You're also betting on the fact that their cost of equity, which means a higher share price lowers your cost of equity, will rise per the forecast. Because if they have to raise $3 billion at, say, $20 per share, you're going to have a lot more dilution on the share count, which is going to reduce your earnings per share and kind of muck up the numbers. So just covered a ton of ground there. All of this is on unhedged. If you go to the Radius company page, including this model, I tried to lay out exactly what's going on. And if you click on any of the cells, you can see the formulas. You can download this to Excel, etc. And Austin and I, of course, are always available to answer any questions. Speaking of which, Austin, do you have any further questions?
I think you nailed it right on the head, man. I think you really walked us through that very well. And as you called out, though, as they raise, more money by offering shares, it really does come down to that specific share price, right? Because if they over dilute, then this whole sort of model falls apart. But if they really come in around that $35 a share range. Now, this is a very attractive idea, especially if they're continually growing at a pace that's not just accelerating, but it just makes sense. So I this is great. Thank you.
Yeah, not a problem. This was fun, Austin. Appreciate you taking the time and hope everybody enjoyed our brief crash course in financial engineering.
See you guys.
Thanks, everyone.